The interregional trade was, always viewed as the opportunity. And some of the rebound, particularly in the third quarter and beyond, has been based on domestic consumption in China and some interregional trade. And so we've seen particularly countries like China, Korea, Taiwan, and Vietnam, Bangladesh, again, recovering, but overall volumes being down. And I think the other factor more than COVID that has impacted trade, as you know, is the geopolitical challenges to a degree has definitely had an impact. And so again, I think, if I look at the year to date, the payment flow has improved significantly since the first half of the year. Do I think we're going to make up the gap from the first half of the year? Probably difficult to do, but I think if you're thinking about it from an outlook perspective, assuming that we don't have a return to some of the challenges that we've had in some of our markets in Asia, feel pretty positive about 2021. Pricing, in Asia has been very thin, whether it's on the lending market, and you've seen what it is on the capital market side. And so, that's something that, has been a challenge this year. Though we've, stepped up and supported clients as where we've needed to. We have to be prepared for a lower for longer scenario in terms of rates for some time. And I do think that means that we need to be more focused on opportunities to take greater advantage of fee-driven businesses and businesses that are going to generate the right returns without necessarily just relying on the yield from your balance sheet, whether that's deposit or loans. I actually think that's a good thing, because I think it forces us and banks to be much more focused on value-added services and driving solutions. This is all about scale, right? And having a proposition that adds value, right? At the end of the day, if we as banks are not adding value in the end-to-end process, I think we will find ourselves challenged in the medium to longer term. And the reality is fees are going to continue to fall. And therefore, being very focused on making sure that we are running a much more efficient platform and lowering our unit cost is going to be critical. And you can do that with a combination of looking at our end-to-end processes. We've talked about the fact as a company at Wells Fargo that we have more work to do in that area. I believe there's actually tremendous scope to lower our unit costs and make it much more effective and efficient through a combination of both digitalization, innovation, but at the same time, being very clear that the value-added proposition and service that we provide from a relationship and a customer service perspective, we see very clearly how much of a differentiator that is. And I equate that also to things like, sanction screening, right? There is absolutely a place, and we need to focus on making that much more efficient, because I would say that's one of the areas where the costs have really gone up for banks. But at the same time, I don't think you can depend purely on technology to manage risk and add value, because I think what I've found is that the insights and the analysis and assessments that we do as risk managers using that type of data is going to be absolutely critical to keep up with what is increasingly a more complex and difficult environment for financial crimes risk, AML issues, etc., which, by the way, is the value add that I believe banks have over any other competitor.